Hello everybody, welcome to our presentation tonight. Freedom Financial Solutions, FFS, how to protect your family wealth. And I'm hoping it will be an interesting one for you all. This is the second time I've presented this and I've added a little bit of information. And that's the good thing about as I present this more and more, I'll probably update it and work out better ways of saying things to you all. But so we're here to talk about the family wealth, but first, I thought I'd introduce myself. I haven't been doing that on a lot of my sessions lately, is I just jump straight into whatever I want to say, because I just presume you all know me, but that might be a little bit presumptuous. And there are more people jumping on of Facebook that may not really know who I am. So I thought I'd better do a little bit of an introduction. My name is Cass Smith. I previously, if anybody wants to Google me to check on me and check the veracity of everything I'm saying, my previous name was Catherine Smith. So all of my career in taxation and real estate and mortgage broking and financial planning and everything has been under the name Catherine. You'll need to find me under that. I'm reasonably qualified. Like I sort of had a bit of a study obsession and went to university and TAFE for around about 20 years. I don't know, I just like learning. So I've got a Bachelor of Commerce in Accounting, a Master's degree in Tax Law. I've got an Advanced Diploma of Financial Planning, a Diploma of Mortgage Broking, a Diploma of Real Estate, a Diploma of Financial Planning again. I did do it twice. I'm a Justice of Peace. I'm a Fellow of the Tax Agents Association. I'm a recognised taxation specialist by CPA Australia. A public accountant and have been for 20 plus years. I'm also a certified results coach. That's NLP stuff, just a little side hobby of mine. I was a tax fraud investigator for 11 years, and I'm an accountant and have been for over 30 years. And I used to be a financial planner for 20 years and a mortgage broker and a property expert for 20 years. So yes, I have done a lot of study and have a lot of experience. So I'm not just any Joe Blow that's popped up waving a flag saying, hey, everybody should get their assets into a trust and charge you a lot of money to do it with absolutely no knowledge or experience as to the legalities and operations of these things. I'll get off my hobby horse next. So I was with the taxation department, so don't hold that against me. There are people out there that think anyone that's worked for the government is a spy for the government forever, but I'm not. So I left the tax department after seeing a lot of corruption and control in the department. Another story I won't go into. Ever since then, I've been helping clients with their own business, taxation, asset protection, and property strategies for well over 20 years. 30 years experience in trust, because I actually wrote my master's thesis paper on trusts. How exciting. I was very excited back at the time. I actually wanted to publish that thesis. I was asked by the University of New South Wales if they could publish my thesis along with another one I wrote on GST, and the wonderful tax department said no. My thesis, my work, tax office said no. So that was probably one of my first eye-opening experiences to the tax department, that it was like, well, why? And the answer was because it told too much truth. And I wasn't allowed to publish it. I was threatened with immediate sacking and loss of all my benefits. I did quit shortly thereafter because I could not handle it anymore. So I went out to be a public accountant, where I spent another 20 years helping clients. Then along came COVID, and I, like so many people, went through a would you call it a breakdown or a breakthrough or just a mental overload, where I just went, what does all this mean anymore? Like everything I did about helping people build property portfolios and share portfolios and superannuation and wealth. What was it all for? We saw in COVID how quickly everything can just be taken away from you, dismantled. The world just stopped. And I gave up and I retired and basically started the campaign trail with various protests and leading the Canberra protests and having a lot of fun protesting against everything that's going on in the world. So what happened a few weeks ago is that I was dragged back to the front line, ready to help all Australians with asset protection, because I was in Fiji for a week, and we'll get on to that in a moment. And it really broke through my psyche how important trusts and asset protection really are. And I've always known that. I've known that since I left university in my 20s. I was an absolute, in my 20s, I loved two things. I'm a very strange person. I don't love much, but I do love two things, which was SMSFs, self-managed super funds, and testamentary trusts. I just couldn't believe how wonderful they were. And now we have another type of trust, which I am in love with as much as I was with SMSF and testamentary trusts. So let's get on to that. So what we're looking to build for everybody's assets is a moat and castle. So just like Buckingham Palace, which is getting a bit of bad press at the moment, let's not think about the bad side of the Buckingham Palace. Let's look at the fact that the royal bloodline and all the other wealthy elite bloodlines and all of the wealthy people have been protecting their assets and handing them down from generation to generation through asset protection strategies just like this. So if it's good for them, why isn't it good for us? So some of the issues that I am seeing that have always frightened me for people, but it's becoming even more important to address some of these things. What happens in the event of your death if there's a legal suit against your assets? What happens in the event of your death is that everyone comes after you. Everyone wants a piece of you. And Australia produces the most amount of lawyers per capita in the world now. It used to be America, and now it's Australia. And a lot of those lawyers look for work. You've heard of the ambulance chasers who, for those that don't know what that term means, as soon as there's a big car accident or a big worksite accident, the lawyers are in there trying to sign up clients on a no-win, no-fee basis. So the same thing is actually happening now with estate planning, whereby when somebody dies, no-win, no-fee lawyers go out there and hunt for beneficiaries to contest your estate. This is the truth. So having assets in your own name is a big mistake. We're going to talk about a solution. So once again, having assets in your own name, the reason everybody does that is that the Australian taxation laws are built for us. They encourage us to hold assets in your own names. We get the capital gains tax exemption on the principal place of residence. Most of you would know that. And negative gearing benefits for investment properties. There's also other land tax and other benefits of holding it in your own name. But having assets in your own name, once again, exposes you to legal battles. Some people have tried to get around this, particularly some wealthy people, actors and things like that, have tried to get around this by putting all of their assets in their spouse's name. That's all very well until there's a separation or divorce, and then it can get very nasty. So finally, the testamentary trust, which I have been recommending for my entire life, since I turned 20 and learned about it, is still very, very good. It's still necessary, but it can be challenged by the family provision claims. So even though we thought it was a watertight strategy, there has been more and more law changes to the family provisions that have enabled beneficiaries out there that feel that they've been left out to attack your estate, including the testamentary trust. All right, so the most important thing to focus here is a question. Just run it through your own head. Who here wants your assets to be passed down to your own bloodline? Most people do. Not everybody. Some people say, I hate my bloodline, F them. But 99% of people do want it handed on down to their own bloodline. And who doesn't want their assets to go to the tax man? That one, I believe, is 100%. Because even those occasional people who don't want it to go to their bloodline, they still don't want it to go to the tax man. And who here wants your assets to be lost in a lawsuit? And even worse is a lawsuit after your death. So people come out of the woodwork and all of a sudden you think you've left your assets to your children or your partner or whoever, and next thing there's people attacking your estate after death. And I could show you, we could spend all night here, me showing you case after case after case, and gone through the law courts where the only people that have won are the lawyers. And the whole estate goes to the lawyers fighting over it. And you know what happens when the whole estate's gone in legal fees? The lawyers just give up and walk away, and the beneficiaries get nothing. So once again, there is a problem with the bloodline. You don't necessarily want to hand your money on to your kids now. So some people do that. They just go, oh, don't worry about all these trust and wills. I'm just going to give the assets to my kids now while I'm still alive if I'm elderly and I don't need them anymore. But you then, those kids may lose those assets under Family Law Act or Bankruptcy Act or a whole lot of other problems in their life. There's also de facto relationships. People are not aware that 2 years means your assets can now be caught up in matrimonial property action. And you don't even have to be living together for that 2 years. And that's kind of scary. So there's also the problem with the bloodline. If you die, sorry about all this death talk, but it has to be, you have to think about this. Sorry. If if an asset goes to a child, maybe adult child even, but there's no strong bloodline trust, once again, that child might have a partner, then they split up, the partner gets it, the partner's children, the stepchildren, all sorts of people can get that asset off that child and it leaves the bloodline. And once again, a claim against the estate can cost hundreds of thousands of dollars. And not only that, the infighting between families, there's probably people on here that have heard of it, know someone whose family just ended up falling apart, everybody hating everybody because they're fighting over money. So that's not all, guys. I feel like I'm throwing extra steak knives in here, but as I said, I was aware of all these problems my whole career. And if people came to me and wanted a very strong will and estate plan, I would put that together for them. But it's very costly. And then it's, well, how much do you pay to protect against all those problems? Some people don't want to pay that much. When we were sitting in Fiji, picture this, we were sitting in a room of about 50 to 60 very high level estate planning accountants and lawyers, hepped up on sugar because they fed us sugar, unfortunately, all week. And I now know that was designed to keep us awake. And we're all sitting there learning all about these advanced trust protection strategies and everything that's happening and lawsuits, etc. When the announcement about the Division 296 retreat on the 3 million super tax. For those that don't know what I'm talking about, the government was trying to tax unrealised capital gains. That is a first for Australia. What that means is if you sell an asset, you pay your capital gains tax after you've sold the asset, normally a year and a half after you've sold the asset by the time you lodge the tax return. What they were now saying is that they're going to, in the self-managed super funds and all super funds, they were going to revalue assets every year, and then you pay tax on the gain, whether you've sold the asset or not. So give you an example, you've got 200,000 in gold. In your SMSF, it goes up to 400,000, just like has happened over the last year. And now the government says, okay, well, you owe us, I don't know the maths, maybe $50,000 in tax. Your super fund doesn't have it, it's all in gold. So now your super fund is forced to sell the gold to pay the tax. Okay, that's not good. But now apply that same scenario to a family farm, which is the number one asset held in the high level, high wealth SMSFs. So the family farm's worth 3 million. It goes up in value $1 million, or let's say 500,000 in a year. They haven't sold it. They're using the farm to produce food. It's a very active farm. It's gone up in value $500,000. And now the tax office say, well, you owe us 200,000 in tax. The family farm's got nothing. For people who know about farmers, they don't have much hanging around, but they owe 200,000 in tax. The only way to do that is to pay that would be to sell the farm. So it was a very bad tax. And it took them 3 years of arguing, and then eventually Labor announced, while all of us accountants are sitting in the room in Fiji, they're not going to do that unrealised gain. Aren't they wonderful? Aren't they nice? They've retreated from it. They realise it's unworkable. So all us accountants are sitting there, and the news flash came through, and we all went, oh, look at this, look at this. And so we decided to devote that afternoon, that day, to analysing the announcement. And all of us just said one thing. All of us unanimously said, this smells, and this has red flags. These are some of the things we picked up. They're calling it a 30% tax, 40% tax. But that's really misleading, because the super above 1.6 million is already taxed at 15%. So the 30% tax is just adding another 15% or 25% to get to 40. So why do they keep carrying on about 30% and 40%? It would have been softer for them to say we're increasing it by 15% and 25%. They didn't. They kept rabbiting on about 30% and 40%. We all thought that is a really clever way to get Australians used to hearing 30% and 40% tax on wealth. We all thought they are slowly pre-programming us to be getting ready for wealth and death taxes, just like the UK and many other countries. There's the death taxes, wealth taxes, and we're going to talk about gift taxes in a moment. But just to put it in perspective, as I said, the UK is 40% death tax. France is a 45%, Japan 55%, US up to 40%. They've got a whole lot of different brackets. So that 40% bracket has never been talked about in Australia before, and all of a sudden they're talking about 40% tax bracket. Very, very similar to a lot of other countries' wealth tax. So we all thought wealth taxes are coming quickly, because the other thing they kept talking about was, oh, isn't it great that we're so good to you and we didn't do the unrealised capital gains tax. But, you know, we've got a really big hole in our budget now, because they were budgeting on this unrealised tax, which was going to bring, I think it was $6 billion. They're like going, oh, we don't have that now, so we might have to, you know, we might have to think of some other taxes. They were saying that the other week. Here we go. And then what will happen if they, sorry, that's cut off a little bit. If they do bring in a wealth tax, what they will likely do is make an announcement. They still then have to get it through Parliament and all of that, but they can say an announcement, usually done on budget night, but it can be done anytime. As of tonight, as of midnight tonight, these taxes are in. So you have no time to plan for it or do anything about it. So what they will also do, and they've done in other countries, and I believe they will absolutely do here, is the night that they announce that, they will also say, oh, and by the way, same with a gift tax. Because otherwise, everybody, if they just announced it without the gift tax and they took a year and a half to get it through Parliament, everyone would just be gifting away their assets to their beneficiaries during that year and a half. So they'll immediately also do gift tax. This is all in my opinion, by the way. They could also wait for a financial crisis, which if anyone's been following me, you know that I keep saying that that is inevitable, right around the corner, any day now. I know I've been saying that for 3 years, but there are so many other experts in the world saying the same thing right now. Almost every day I turn on the news and there's another senior executive of so-and-so or a wealth advisor or a senior person saying that the crash is inevitable. So after that crash happens, that's when they could bring in the death taxes. They could bring them in any time, but this would be a way where they would say, oh, you know, everything's broken, we need more taxes, so we need a fair solution to rebuild back better, and effective immediately. So my advice to everyone out there is don't wait for Canberra to decide what they want to do with your money. It's now is the time, and this is why I got so excited over in Fiji. As I said, I don't normally get excited, but I was just over there like on the edge of my seat wanting to get back to Australia to start implementing this, because now all of a sudden, everything that I've known for 30 years, everything I've worked with for 30 years, everything I've encouraged people to do for 30 years is now time critically important. You may have a few months, you may have 6 months, you may have 18 months, I don't know. but it is coming down the line, and those that put their assets into protective structures beforehand can, as far as we can tell with the current laws, get around what's coming. And once they do introduce it, it'll just be way too late. Same with the financial crash. If you don't get your money into hard physical assets now, don't come crying to me afterwards, because the day when the crash happens on the share market, it can happen in a matter of days, if not one day. People who have been in Bitcoin saw that in the last 2 weeks, just woke up to go, oh my God. Yeah, so the gold market has crashed. I absolutely acknowledge that, but I don't call it a crash when it's gone up 100% and now it's retreated, I don't know, 10% last time I checked. So it's still up the 90%. So, but the share market, on the other hand, can crash 80% literally in a day. So don't wait for that either. Anyway, I'll get back to taxes and protective trusts. So what is the solution to all these problems that I have been talking about? The solution is what we call a family protection trust. So it's different to a family discretionary trust, which I have dealt with a lot. It's different to the testamentary trust, which I have dealt with a lot. This is a family protection trust. The best way of looking at it is it's designed to protect your wealth during your life, whereas a testamentary trust is to protect your wealth after you're dead. You can call this a living trust. It's not the same as the living trusts in America. They are different, but these are just as good in Australian laws. They just don't have some of the tax benefits as the American one has. Excuse me. So the family protection trust, well, the ones that we set up, have only your bloodline as beneficiaries, including any trusts or companies they may belong to. So what do I mean by bloodline? Obviously, it's simple. It's your own bloodline. So, and these have been tested in court. The case is Caldwell versus Caldwell, I believe. And it went to court whereby the father had passed their wealth down to their next generation, died, passed his wealth. His adult children, well into their adulthood, very, very late on in life. The wife divorced the husband. Wife went after husband's assets. The court, in normal cases in family law, the court will look through a trust. In this case, went through court and the judge said, I'm sorry, but wife, but you are not bloodline. And this trust is clearly a bloodline trust and you cannot have any of it. So they work, they've been tested in court. So we established the Family Protection Trust through a gift of your net worth, through a deed of gift backed by a promissory note. I'll explain that in a diagram in a moment. There's no capital gains tax or stamp duty, and I'm going to hammer that point home. The amount gifted is capital of the trust and it's lent back and paid at minimal interest rates payable at the end of the loan. And the loan is secured by a registered mortgage over a property. That's a lot to take in. It took me a long time to fully get that into my head. This is it in a picture. So your assets, in this case, Tommy, Anna and Will, that's the beneficiaries. The parents' house, car, shares. You can also do jewelry. You can do whatever you want, but your major assets, your major valuable assets are gifted over to the trust. There's a loan back to you. So there's actually, it's hard to describe. And what I do for people, which I'll talk about later, I do a strategy paper where I actually look at your scenario and I come back to you with what you're going to do and I explain it in great detail. But this is the mechanism of how it works. So basically you're shifting all your assets into a trust. That's the easiest way to explain it. The result is, as I said, there's no capital gains tax or stamp duty. And I'm going to explain why that's so important in a moment. If you get sued, your net wealth is in a trust. It's protected. You have no assets. Somebody can sue you all they want and they will get a diddly squat. You have to be careful who acts as trustee and appointer, and we talk you through that because you want to keep it in your control. It can afford the family law protection. So it won't, for any of you out there going, oh my God, this is so good, going through a divorce, it's not going to help you now. It's not going, and if you're in a current relationship and you have joint assets, you're not going to be able to set it up to exclude the current partner. It is more for future relationships and for future generations. And for estate planning, it sits outside the estate. So that's the reason that's so important, is that those beneficiaries out there, that those no-win, no-fee lawyers are going to try and get to challenge your estate, can't challenge this. So putting it in just an example, because I think that helps people. This is a very, very just common mum and dad couple that I would see 6 or 7 out of 10 of my clients. Average mum and dad, they've got a principal residence worth 1.5 million, a mortgage of 500,000. They're both on salary and wages, very, very simple. And I'm just going to project that in 10 years' time, that property might be worth 3 million. So in one scenario, and this is a scenario that some people who I believe are not qualified to advise have been telling people to transfer their assets to a normal discretionary trust or a private trust. They're the same thing, or a foundation or a charitable institute or whatever they're calling it. Transfer your assets into this and that will protect you against everything. It will not. It could cause you some serious problems, and those people giving that advice will be liable for their advice. Because if that couple transferred their property into a trust or a private trust, they would pay stamp duty of $65,000 immediately. They would lose their land tax exemption, depending what state you're in, approximately $5,000 a year for the next 10 years, $50,000 in land tax that they wouldn't otherwise had to pay. Main one is they will lose their capital gains tax exemption. So when they sell that property in 10 years' time for 3 million, they've made a gain of 1.5. They're taxed at 45%. So they're taxed at $337,000. Total cost over 10 years to that couple for transferring a property into a trust is $425,000. Hence why I've been screaming from the building since COVID started, when people are telling other people are saying, put your home in a trust. I have been saying, no, don't. This is why. And I'm sorry if any of you out there have done that on somebody else's advice. I would be suing them. Anyway, getting back off my hobby horse. So normal trust is not good, but let's look at the family protection trust. As I said, there's no stamp duty, no land tax. You still get the full capital gains tax exemption. And then if that's not enough, look at the death tax that you may save. So the death taxes, if they bring it in the same as the UK, 40% on that $3 million home. And that's just in 10 years. Imagine if this couple, lived till 80 and the home's now worth 10 million, depending on which way the property market goes. So the saving by using the family protection trust is 1.2 million in death taxes. So the total saving, this is just for 10 years with one average couple, is $1.6 million. This is why I got so excited in Fiji, because I now realize that everyone out there that is holding property in their own names, whether it's your own home or investment properties, you can transfer them into these trusts, not trigger all those nasty taxes, and protect yourself against these future taxes, plus all the lawsuits and everything else I spoke about in the beginning. Because wait, there's more. You get asset protection. Shield your family assets from divorce and family law claims, bankruptcy and creditors, beneficiary misconduct or immaturity, maintains control and integrity of the family wealth, especially in high-risk professions or volatile relationships. It enables intergenerational wealth transfer, enables the assets to be passed down to the next generation without any stamp duty or capital gains tax. And the wealth can be held in that moat and castle that I first started with. It can be held in the moat and castle and handed down across multiple generations, bloodline family only, for generations to come. There's protection from beneficiaries themselves. That may sound a little bit challenging, but I have spoken to a lot of people that have beneficiaries, adult children, they love them to death, but They might have problems such as addictions and gambling, or they're themselves going through a bankruptcy or a divorce, and the parents don't want the money going into their hands for reasons like that. There is also disabled children, more and more of them more recently, that you might want to have a special trust for. So the control of these trusts remains with the trustee and appointer, and that is whoever you choose, and it can be yourself. You are looking after it. And it doesn't affect Centrelink because there's no fixed entitlement. This sounds, once again, like I'm selling steak knives, and there's more and there's more and there's more, because this is an amazing strategy. It has been designed by who I believe is one of the, if not the best tax a lawyer that has specialised in this for many, many, many years, and he's handing the knowledge on to people like myself who have also specialised in it from a taxation point of view for 30 years. The estate planning asset protection is that so what we've done is we've set up a living will, and we've put all your current assets in the living will, in the living trust. When you pass away, probate and all of that doesn't affect all these assets. So these all can be just handed to the next generation without probate, without family provision claims, and without anybody being able to contest it. So it's absolutely amazing. It sits outside the estate, and there is more. I could go on all night, but I think I've said enough to overwhelm a lot of you out there already. So in summary, it's the Buckingham Palace of trusts. Been involved with trusts for more than 30 years. I've used them with clients for businesses and investment properties and testamentary trusts after death. But I always advise people not to transfer your family home. Explained this before, I'm just summarising it. You don't transfer it, used not to be able to transfer it because of stamp duty, capital gains and land tax. Now we have a trust and a structure and a way to avoid all of that, and to do it for asset protection, generational wealth protection, and before the gift and death taxes come in. There is a downside. It is costly. I make no bones about it. There is a lot of work in it. We have looked at it to try and bring our price down as much as we can, and we have, but even then, it costs between 10 to 20,000. But when you think about that average couple, it's less than 1% of their net wealth. And everyone that I've done a strategy for so far, it's less than 1% of their wealth. It's also less than 1% of that future tax. So I view it as an insurance policy that will last your lifetimes and generations to come. I have even had an example of a elderly couple that didn't really want to afford this. They could, but they didn't want to, because it's really protecting the beneficiaries. So they actually got their adult children to chip in as well, because in the end of the day, it's going to save the adult children their assets. So think of it as an insurance policy. A lot of people will pay $5,000 to $6,000 a year now for household insurance in case the house burns down. The chance of your house burning down is very, very, very minimal. It'll be less than 1%. Less. The chance of you dying is a bit more than 1%. In fact, it's the only unavoidable thing in life is death. So this is an insurance policy that you pay once, you set it up forever, and then when you die, you are saving so much money. So the tax savings for an average couple was 1.6 million. That's one property, one average couple. I've done strategies for people that have got 8 properties. I've done them in the last day or two. And once again, the costs are even less of a percentage for them and even more important. So we do have payment plans if you really can't pay for it. We're hoping that won't come too often, because then we get to struggle on our cash flow because we have to pay lawyers to do all this for us. But we will offer it where absolutely necessary, because I don't want people to completely miss out on this just because they can't afford it. You could also consider drawing it down on your home equity, refinancing, taking a personal loan. So where to from here, and then I'll open up to questions, is to get started, we charge $500 plus GST. And I draft a strategy paper for the ones people I've already done it for. It's a 10-page document tailored to your exact situation, where I go through everything that I would recommend. We then give you that $500 back off your final bill if you proceed with any of the services. And everyone I've presented to so far has said yes, because even if they can't do the whole lot, they'll still do some of the strategies, because everyone out there, if you have assets, you need some of these strategies. So we'll also consider things like SMSF wills, testamentary trust, everything I can see in your family estate planning situation goes into the strategy paper. For that $500, I present it along with a PowerPoint presentation explaining it, and then you choose whether you want to proceed and what you want to proceed with. I will stop sharing that and open up for questions, and I can have a drink. So to ask questions, put your hand, either raise your hand and unmute yourself when you're ready to talk, or put it in the chat, which I will be checking now to see what's in there already. Yes, Mark asked if it's recorded. Yes, recorded, and this will go up on our YouTube channel. Mary Jane's pretty quick, probably up to be up there. She says either tonight or tomorrow. It's all about children. Yep. Land grab of the making, absolutely. Martin saying that, absolutely. Or money grab. Some people saw what I posted on Facebook this week about they've introduced a pet tax in Victoria. So it just never ends. They're going to tax every single thing in our life. Yeah, just having a look. Okay, Bronte, you've got your hand up. If you just unmute yourself, yes.
Yeah, I've unmuted myself. I don't know how to get my video back up, but that's okay. So I've set up a family protection trust, but I'm about to buy a new house, changing homes, and I didn't, if I had put it in when I set the trust up, I would have been liable for land tax. So what's changed?
This is a different strategy. It's a different type of trust. And when we don't transfer the asset itself, we transfer the equity by a gift and loan back strategy. It's complicated, but it works. So if you have already, did you say you have already bought that house?
Well, I've contracted to buy it. It settles on the 25th of November.
Yeah. That's fine. So you will still settle it. You'll still buy it in your own name. That's fine. And then we do the protection strategy after.
Okay.
Yeah. Excellent. How is the marital partner protected? And this is Martin again. I'm not sure. Can you want to unmute yourself and explain that question, Martin? He's looking at the screen. Yes, that's it. You should be right to talk now, Martin. Yep.
So to me, it's what I'm hearing is that the trust is in one name, but there's two people in a marriage. So which person benefits? How do both benefit out of this trust?
Yeah.
So one's not blood, because say the father is the bloodline for the children.
Yeah.
But not the wife. He's not the bloodline of the wife. So you're saying she is not blood. So how is she protected under this?
So it depends what the family actually wants to do. So if it's a husband and wife I'm going to say in most cases, but let's just, I don't know. The husband and wife will normally want the trust together. It will be a husband and wife trust. The both of you will be in there, and it will be both of your bloodline. That's in one scenario. There may be other scenarios, one I was dealing with today, where it's the second marriage, they've both come in with separate assets. They're going to have separate bloodline trusts so that their asset goes down to their bloodline and the other person's goes down to their bloodline. It's really up to the family to, and then there's another example where there is a husband who's married the wife, the kids aren't his, but he loves the kids even more than his own kids. So, there's so many different scenarios, and that's why the strategy paper is individualized to each different person.
Yeah, so you're basically both taking control of everything and not requiring the courts to make the decision for you. Yeah.
You're keeping it within the family. Yeah.
Yeah. Very good. Thank you.
Someone's asked, can it be paid for from your SMSF? Some of it can be. So any part of the strategy that relates to super can be paid for by super. And we do sort of weight some of the costs towards the super fund to make it more affordable for those that want that done. But not all of it, because some of it is in relation to your personal assets. Brad says there's a new type of trust. No, it's not new. It's been around forever and a day. It's becoming extremely popular right now because same reason SMSFs became popular and gold and silver have become popular, is that everybody's now thinking about these sort of things. And people are saying, I want to protect my assets, and how do I get this tax man off my back, and how do I protect myself going forward? So no, they're not new. They've been around for decades. Most accountants don't know about them and even I knew about them, but in the past it was like, yeah, I knew about them, but it was only very, very high level clients that would want to pay the money for that sort of strategy. But then, as I said, this death tax coming down the pipeline just changes everything to me. You've got to get your assets out of your hands before that happens. Okay. Rob has asked the ongoing costs. It really depends. I spoke to our head lawyer about that today. If you're just putting your home into the trust, there's no ongoing taxation obligations, there's no reporting, there's no nothing. So technically no costs, but we would encourage people to do a basic set of accounting just so you're keeping account of what's going in and out of the trust, just for your own family records, and so that when you die, it's all a lot easier to manage, which you could pay an accountant or a bookkeeper, or within a year or two, probably ChatGPT, just to do that accounting for you. So the ongoing cost should not be much. On the other hand, if you move a whole lot of investment properties in, yes, it will then need, or crypto or things that are making income and gains, then you'll need accounting done. But you would need that accounting done anyway. You're just going to get the accounting done in the trust now instead of in your own name. I think that's all the questions in the chat. Does anyone else online have a question? Want to raise your hand? Chris has got his hand up. I think it's Chris first.
Yeah, g'day. I've just got a crypto portfolio at the moment. It's worth about 70. It's going to be worth millions in the future. So is it still like a 10K setup fee just for, that's all I've got as a asset at the moment?
Yeah, no, not fully 10K, but there will still be cost because that's the protector trust that is the costly bit. But yeah, if you have the strategy session with me, I'll quote the exact cost once I know exactly what I need to do for you, because you might have some other things you're not aware of, like a standard will, enduring power of attorney, other things that need doing as well.
Copy that. And then later on, if I was to buy property, would that change the fees again, I suppose?
Yeah, well your trust would already be set up so that you wouldn't have to pay that again. Then you'd just be paying the gift and loan back paperwork to get the property over to the trust.
Yeah, all right, thanks for that.
Excellent. Later, is it?
It's Lata. Hey,
Lata.
Cass.
How are you?
I just have a question. It's regarding my son. So he's selling his house. So he's going to have cash at bank soon. If he were wanting to set up a discretion of the trust should be I think he also has crypto. But the trust would be purchasing gold and silver, for example. Is that correct? Is that how it would track?
Yeah, absolutely. If that was the case, I think you do say he's already got the cash.
Well, let's say, the house is on the market, the cash is going to go to bank. So in between time, if he were to set up the trust, it's better that the trust purchase gold and silver, purchase crypto, purchase whatever.
Absolutely. And that brings the cost down a bit as well, because we don't have to do gift and loan back. We just set up the trust right from the beginning, and he buys straight in the trust from the start.
Right. Yep. And future property, were there to be property, can go into the trust as well.
Yeah, absolutely.
Yeah. Right. Okay. Thank you.
No worries. Cass, am I taking the appointments yourself? Yes, I am. So that's what I mean by I'm back on the front line. I desperately tried to retire, and I did. I was off for about, probably slow for a couple of years, and I've had some time off. But because of this, I'm back on the front line taking the appointments, and I do these strategies and these presentations, the strategy presentations myself, because they're bringing together, even though it's about this this trust product in particular, it's also everybody's questions are bringing together mortgage questions, property questions, tax questions, capital gains questions, all of these things. That it's my 30 years of experience that enables me to think my way through all of these strategies and put it together. It'd be very difficult for anyone else in our firm or even any other accountant, because don't forget, I'm not just an accountant. I was also a financial planner, a mortgage broker, a real estate agent, a property advisor, blah, 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 blah. So it's all of that experience that is enabling me to put these strategies together. So how does it work if you currently have a partner, wife, and set it up for protecting your bloodline? Yep. Protecting what you can gather. Yeah, if you're single, Brad, I can't quite understand if you've got a microphone and want to put it on. If you're single, but what I will say on that issue, just because you're single doesn't mean that it's not important to use these to protect your bloodline, because what I also mean by the bloodline is your adult children live with someone for 2 years, and then all of a sudden you've got bloodline challenges. So it's not just about you, it's about your future generations and what relationships and messes that they might get involved in. So it's protecting the bloodline all the way down for the future. How does it stop the assets going to probate? That is a fantastic question, Nicola. So basically, your assets have already been moved into this trust. Your net asset is zero. You've moved everything over into the trust. So when you die, there's no assets there to go to probate. You might still go to probate in terms of you might have some money in the bank, a couple of $1,000s in the bank, or a car, stuff that you haven't transferred to the trust. That will go through probate, but that will be smaller issues. Most of your net wealth will already be over in the trust and not challengeable. Mark, you've got your hand up.
Okay, yes. So how does this affect the downsizing rules in relation to selling our family home and being able to use those downsizing rules, which we can do in 2 years from now? And we're 56, so we're looking at retiring at 60. Take advantage of that, so you can put X amount, I think 300,000 each, into our self-managed super fund, which we got you guys to help set up. Thank you very much. That's been an absolute bloody goldmine.
Right.
So
Literally
does it affect those in any way?
Literally a gold mine.
Yeah, silver mine, gold mine, and just honestly, it's been fantastic. We've accelerated ourselves so far. It's not funny, so do appreciate it.
Great, thank you very much. So that's a good question. And the other good thing about what I'm doing is that, as I said, I've been doing it for 30 years, but Grant Abbott, who designed this part of the strategy, he's been doing it for 30 years on the legal side. So any questions I can't answer, I run past him. But I think the answer to your question would be the part that you want to put into the SMSF under the that provision, the downsizer provision, we would probably leave that amount of equity outside the protector trust. Because the idea of the protector trust, when you sell the house, all the money of the sale is going to go to the trust to pay the loan. So you wouldn't want that, because you're going to need the money to put it into the SMSF.
Okay, so you would have to. So you're talking about sort of splitting the asset, the asset in a liquidity sort of way. Is that correct?
Yeah, exactly. And that's what I'd do in a strategy paper for you. I'd break that up and say, okay, because you're using the downsizer, your strategy is going to change slightly, and we'll do it with this much equity and leave the rest sitting there for the downsizer contribution.
Okay. All right. No worries. Well, I think we'll book a session with you. Thank you very much.
Yes, no worries at all. Anyone else? We're coming up on 7:20 anyway. So, yeah, Martin.
I was on last week's session as well, and I mentioned that I'm buying a business in 2 weeks, and you said to me to contact you for setting up a trust for the business first as a priority.
Yeah, absolutely.
So what's the cost in doing that? And then how do I transfer that into the family protection trust?
We would not put a business in the family protection trust. It's very, very important. This is number one rule in accounting and business is we don't mix businesses with assets at all. So you will have to, in this case, a separate family company as trustee of a discretionary trust. That's just the standard discretionary trust I've been doing for years. We set one of them up to run your business.
So do I take the business tangible assets and put them in the family trust?
If,
Or
yeah,
would-
we could talk about that. If there's a large amount of tangible assets or what we call IP, the assets of the business can sit in the trust,
Yeah.
but you run the business, the part that could get sued, in a normal company and trust.
Okay.
Yeah.
Thank you.
Yeah, book in for a strategy session and we can work through that.
Yeah, I've sent an email. I just haven't heard. So yeah.
Follow it up. We normally hear, you can book straight online. Mary Jane, I'll just put the website in there. You just book in on the left-hand top of the website. There's just a book now button and you just book to see me.
Yeah.
Yep. And
Okay,
do
I'll
so
do that.
because I am getting booked out very quick. And if you're buying something in 2 weeks, we need to do something quickly.
I will.
Okay. Thank you.
Thank you.
Okay. If anyone else put their hand up or a chat, otherwise I can knock off because I was on Voice of Freedom last night with Carl Leibold and we did make a joke that I texted him at 5 o'clock that morning, and it's not normally me. I'm normally I love my sleep, and so for me to be up at 5 o'clock in the mornings is just an indication of how excited I am by all of this and how many hours I've been working to try and keep up with everything. So jump in and get sorted as soon as you can, and we will probably run this again. We've probably got enough people going at the moment. We probably won't run this one again for a few weeks or so, but if anyone wants to see it, the replay is going to be on our YouTube channel. So, all right, thank you everyone, and I look forward to helping you all out. See ya, bye.